Good morning, everyone. My name is Damaris Mukulu, the head of brand marketing and communications at Genghis Capital. Welcome to the Genghis Weekly Investor Briefing. We're excited to have you here today, as well as our research team that comprises of Melody and Wesley. As always, we're going to begin with an overview of last week in terms of the macroeconomic developments in Kenya. I hope Melody and Wesley will touch upon the fuel prices, which have us all in shock and reconsidering carpool. We are also going to be reviewing the fixed income markets as well as the equities markets. In addition, the team is going to share with us their projections for this coming week, as well as their trading recommendations. This session is interactive, so please feel free to use the Q&A tab to send in any questions you have for Melody and Wesley. And at the end of this session, after the presentation, we're going to tackle each and every question you have. So take advantage of the opportunity and send in your financial markets questions. I think we're ready to begin. So Melody, please take it over.
Thank you, Damaris. Let me share my presentation. You can see my screen?
Yeah, I see it loading.
Okay. How about now?
Not quite yet. It says Melody has started screen sharing. Maybe you can try again.
Oh dear, it's hanging a bit.
I can be of assistance. I can pull up the presentation for you and project it on my site. The one that Wesley shared this morning.
I think Melody is having some connection issues.
Yeah, I think so too. Or Wesley, do you have it at hand, the presentation?
I don't have it at hand.
It's okay.
I have issues logging to Horizon.
Has it come in now?
Not yet, Melody, but it's okay. I am. Oh, there you go. Yes, now we can see it.
I'm not quite sure why it's misbehaving.
It's okay. Technology can be a
One
mess.
of those things, yeah. Okay. Is the presentation showing? Or
yes, it is.
And now?
Yes, we are on macroeconomic review, fuel price review, the very first topic.
Okay. So just touching on the oil review. So EPRA on 15th reviewed the fuel prices upwards to get to record highs. This was mainly because the stabilization fund was not being used in this pricing cycle. So that's what they've been using before to cushion consumers from the rise in price. So this rise is also affected by the fact that the crude oil prices are going up and the shilling is also facing pressure against the dollar. So the government has been using the Petroleum Development Fund levy. Now the thing is this this fund doesn't have legislative framework for withdrawals in place. So not very sure how withdrawals are supposed to be done from that fund. So what they were doing, they were let's say compensating the oil marketers from this fund. So the government has decided now that they're going to reduce the jetty handling and storage fees for this the oil marketers. So that's hopefully it can cause some reprieve, but unfortunately that doesn't seem like it's going to help much because also in addition they want to increase the excise duty on fuel in October 2021. Though this is still pending approval by Treasury, it's supposed to go up on various items, including fuel, to cover for inflation for the previous financial year. So with approximately 45% of, more or less near 45% of the pump price belonging to taxes. Most manufacturers are up in arms and they're asking that the EPRA pricing formula should be reviewed and also the tax regime. Another thing is also electricity costs are going to be up this month due to now Kenya has been using more of thermal energy than the hydroelectric energy, also because of low rainfall. So the EPRA as well, they pushed up the fuel cost charge to 3 shillings and 88 cents for electricity for this month. So that's going to add another dent to the wallets. Secondly, there was also the presentation done by the CBK Governor, Dr. Patrick Njoroge, on the public debts. So from this presentation, mostly the main point was that there is need to rein in the country's borrowing, mainly because now we're heading to a place where we have a high risk of default. So looking at the public debt to GDP ratio, after the rebasing that was done recently, it improved marginally from 69 to 67.5%, though it's still above the 55% threshold. So the government explained that this was mostly due to economic shocks, low revenues, poor export earnings, as well as worsening terms for the new loans. Also, we've seen that there's been increase in development expenditure with the current roads you're seeing being constructed, and also recurrent expenditures. So the governor stated that this high debt is going to cause a narrowed fiscal space, constrained fiscal barriers, as well as it might lead to an increase of interest rates for both the foreign and sovereign and private sector. So another note, looking at the debt, it's mostly been moving towards the commercial debt, which we know is quite expensive. So the government is anticipating that the servicing of these loans to revenues will go down in the medium term, as they're planning on getting improved terms on loans and also restructuring the external loans, commercial loans that the country has at the moment that have heavy maturities. Also, 67% of the debt is coming from China as of June 2020, and this can bring about an issue of concentration risk because it's just coming from one country. Looking at the domestic borrowing, it's actually ahead of the curve, and we might see government slowing down on domestic borrowing. Just another pointer, the government had successfully applied and has been given the debt service suspension initiative for external debts. It was extended from June to December, end of this year. So though this is just a temporary solution until we can actually find a way to manage our debts. So some of the solutions that had been put across is fiscal consolidation, refinancing of these expensive debts, and also efficiency in government spending. Moving to the fixed income markets. So the secondary market activity went up 243% week on week to 39.6 billion, mainly due to the interest in the infrastructure bond segment. So overall, the yields have been more or less steady, though there's been just a small decline at the front of the curve. Looking at T-bills, the performance fell from 72% to 72.7% the previous week to 54.6%. Mainly, it's due to the continued interest, as we've seen in the infrastructure IFBs, that's the infrastructure bonds secondary trading. So the yields went up an average of 5 basis points week on week, and as we have noted that CBK has been reducing the refinancing risk by rejecting these expensive bids that are put across for the T-bills. So they're just taking enough to cover their maturities, even when there's an oversubscription. Moving on to the liquidity trends. So looking at the open market operations, this is where the government, the CBK comes in to either inject or mop up liquidity. So last week, the Apex Bank was mostly injecting liquidity to the market using reverse repos that came to about 30.8 billion at an average rate of about 7.4%. So reverse repos just generally used to raise short-term capital, and it's where government, the central bank purchases government securities from commercial banks. So that the rate that they pay is called the reverse repo rate. And as you can see, it's higher than the target. Then, as we said, because of the settlement of the IFP 2021 bond, which was on Monday on the 13th, that's why you could see that the liquidity was rather tight. So the average interbank rate went up 60 basis points to 4.24, with transaction volumes coming to 82.6 billion. Just goes to show, with the rise in the rate, just goes to show that there's some tight liquidity in the markets. Domestic borrowing is at approximately 260 billion. This is inclusive of the CBK overdraft. This is about 41% of the target of the 658 billion. That just goes to show that we are ahead of the curve, because looking at the prorated amount, it's supposed to be 164.5 billion. So as I'd said earlier before, we might see some slowdown in government lending. For the macroeconomic calendar, we have a T-bill auction on the 23rd of September. That's the 91-day, 182-day, and 364-day T-bill. That's going to come to about, they're looking to get about 24 billion shillings. So for the trade of the week, the range it's a buy recommendation for the IFP1 2021-21. Between 12.4 and 12.45. So we expect that this interest on the IFB1 2021 infrastructure bond to continue, mostly because there's an upcoming maturity as well as a partial redemption this week. So we anticipate that investors will redirect the funds from this redemption and maturity to this bond, and also because it has an attractive coupon rate. So I'm going to hand it over to my colleague Wesley to take us through the equities markets.
Thank you, Melody. Good morning to you. Company announcements have been subdued in the bourse, this being a fortnight or so after most of the listed companies released their full year results. On Monday, we saw Kengen in a publication announcing that it has been cleared to sell an equivalent of 4.6 million tons of carbon emissions credits it earned over the last 18 months. Then the news on Centum planning to sell part or all of its stake in the Centum real estate in line with the Centum 4.0 goal of reducing the real estate share to a bracket of 45 to 55% of the total weighting. Moving on, the market was mixed as signaled by the benchmark indices. The Nairobi All Share Index rose by 1.4% week on week, while the NSE 20 Share Index shed 10 basis points on a week on week comparison to settle at 2061.45. Sanlam led the pack of the week's top gainers on a 15.93% week on week rally. Have already gained 9.78% week on week and closed the week at 1 shillings and 1 cent. Kenya Power, on the other hand, rose 7.6% week on week to settle at 1 shillings and 70 cents. Umeme and Kabasit gained a round figure of about 5% in the week to settle at 7 shillings and 11 shillings and 55 cents respectively. The uptick by KPLC is likely on the back of sentiments by the Ministry of Energy around a bounce back to profitability. We hold an out of consensus stance that speculation on how rosy the full year 21 numbers will be a key driver to the counter's price action in the near term. Also, as a side note, News on KPLC hiring new debt collectors to help recover dues, plans to set up an intelligence system that's in a partnership with Safaricom. This intelligence system is expected to help connect electricity meters to a central location with the aim of reducing what they call system losses, which are the difference between the power bought from producers like KenGen and the actual power that reaches the final consumers. And also how the cataclysmic shakeups on the board, coupled with how the adoption of a local currency-based tariff for the Kenya power purchasing agreements will pan out to be, might set the company on a new trajectory. And as Melody pointed out, on a more consumer relatable news, the price of power is expected to rise to about 26 shillings and 57 cents a unit on the back of a rise in water levy and electricity billing. Moving on, Uchumi led the week's laggards, shading 15.38%, closing the week at 22 cents. Standard Group shared 10.8% week on week, while Scan Group 5.6% week on week to settle at 16 shillings and 5 cents and 5 shillings and 20 cents respectively. NSE and NBV dwindled by a round figure of 5% to settle at 6 shillings and 46 cents and 9 shillings and 26 cents respectively. Looking at foreign participation, foreign investors regained their dominance, accounting for 63.6% of the week's turnover. They sustained a bullish stance during the week, mostly buying into the banking sector while exiting on Safaricom and EABL. Longhorn publishers released their full year numbers, and looking at their numbers, they registered a 16.5% year-on-year top-line growth, with revenues coming in at 1.2 billion. Uganda recorded the highest growth at 83% year-on-year. Kenya followed at 18% and Tanzania at 8% year-on-year. Looking at the cost of sales, they grew 28.6% year-on-year to 746.5 million, translating to gross profits of 497.4 million. That's about a 2.1% year-on-year growth. Operating expenses, on the other hand, declined 53% year-on-year and came in at 296.4 million. The decline was attributed to cost containment measures. Finance costs grew 20.6% year-on-year, closing the period at 183.2 million. The growth was attributed to regional expansion, product diversification, and digital transformation in the e-learning and the e-book platforms. Earnings before tax for the period under review was reported at 17.8 million, and the earnings after tax came in at 7.5 million, 103% year-on-year growth from losses of 225.9 million in a similar period last year. The counter's balance sheet grew 17.5% year-on-year to 2.9 billion, and it closed the period at a cash position of 36.9 million, which is a 68.2% year-on-year decline. We hold a view that the return to profitability was expected on the back of reopenings of the education sector, and we hold a cautiously optimistic view on the future outlook of the counter, as we expect the profits to be sustained by the company as it invests into the e-learning, regional expansion, and product diversifications. Looking at the sub-Saharan market performance, the Nairobi All-Share Index outperformed its peers on a week-on-week median. The market price to earnings ratio was above the African median multiple of 9.8, while its dividend yield was below the African median by 200 basis points. The corporate calendar indicates that the book closure for BOC's 1 shillings and 50 cent interim dividend will be on Friday, that's the 24th of September, and Centum's 33 cents full dividend book closure will be on the 8th of October. To you, Melody. You're on mute.
Oh, sorry. Thank you. So I'll be taking you through the financial sector highlights. So looking at the banking sector, there were some mixed moves in prices. So equity, HF Group and KCB, they rose 2.5% week on week to 53.25, 2.9% week on week to 3.92, and 3.7% week on week to 48.55 respectively. BK Group and DTB Group, however, dropped 5.2% week on week and 3.5% week on week respectively to 28.45 and 62.75. So moving on to the insurance counters, Sanlam was the highest gainer, rising 15.9% week on week from the start of the week to 11 shillings and 50 cents, to close at 11 shillings and 50 cents. Liberty, CIC, and Jubilee, however, experienced contractions in their prices. So looking at what's happened during the week, CIC Insurance launched a medical cover for senior citizens. So they want it to go to as high as 80 years old, as it targets to grow its revenues and also expand its market share. Though few insurers actually cover this age bracket because they're normally categorized as high risk. So maybe this is one of the sentiments that investors had, and we saw it reflecting on the counter's price. So as a group is diversifying its product offering, so the management is focusing on its turnaround strategy. We saw that it changed its leadership in both the senior management and board level. And it's also made a turnaround from the loss position that it had last year to post a profit of 260 million shillings in profit this year. So they also said that in terms of deposits, they're going to continue, in terms of dividends, they're going to continue assessing the performance, and the board will determine if they'll pay a dividend at the end of the year. So another occurrence in the market was that Liberty Holdings, the additional stake transaction was completed. So Liberty Holdings Limited, and the main company in South Africa, has raised its stake in Liberty Kenya Holdings to 73.5%. So this is following the subscription of additional 84.2 million shares from two large institutional investors through a private transfer. So this increased stake will give Liberty Holdings more control, more or less, let it have a bigger say in the Kenyan-based units, and it will see more decision-making power in the company. So this transaction is set to lower the capital holdings of the firm and increase the earnings per share due to the fewer shares in the market. So Liberty, however, doesn't intend to buy out the minority shareholders, and it also doesn't plan to delist from the Nairobi Stock Exchange. So something else to note is that Standard Bank actually reveals its plan to acquire 100% of Liberty Holdings. Now this is the parent company of Liberty Holdings Kenya. So they say that this is supposed to be a move for a natural progression in the relationship in line with their strategy for a wider set of financial services to its customers. And it's one of the largest providers in the continent. So right now, Standard Group owns 31.18% of Liberty Holdings Kenya. If you do the math, that's 54% or 57.7% of Liberty Holdings. So looking at the insurance industry, we might see an increase in mergers and acquisition transactions, especially due to the implementation of the IFRS 9 and IFRS 17, which is supposed to require more capital. So this move to a risk-based capital adequacy framework will lead to now capital raising initiatives, and you might see small players in the sector being acquired to show up their capital. We also saw that Jubilee and Allianz have also created a partnership where Jubilee has sold a certain percentage of its business to them. Lastly, is the slow progress in credit guarantee scheme uptake. So the Parliament's Budget Office, it last week released the Budget Watch report, and it observed that the disbursement of this, the credit guarantee scheme has been slow. So this had been set up last year with about 3 billion shillings, which was supposed to be extended by the commercial banks to SMEs. So this act generally is supposed to act as insurance to commercial banks so that it can give them the confidence to extend credit to SMEs and reduce their collateral requirements. So right now, or rather as per the latest figure, the amount disbursed was 296.4 million out of the 3 billion that was set aside. And this is just about 9%, 9.8% uptick. So as at December 2020, the banking sector, the gross loans were about 3.1 trillion, of which only 638 billion belonged to the SMEs. What we can infer from this is that the banks have been more inclined to lending money to the government more than giving it to the SMEs because they are viewed as high risk. And bonds are perceived to be risk-free as compared to lending to the private sector. However, looking at banks this year in 2021, they've been accumulating capital from international institutions like IFC, World Bank, Africa Development Bank, so that they can strengthen their capital as well as for onward lending to these SMEs. So it came to about almost 100 billion that was acquired this year, though now that has been slowing down as the year progresses. So now the only major issue is now the burden of proof is on the banks to actually show that they're lending out this money to SMEs. We've also seen that the private sector credit growth rate has been slow. It's been about 7.7% as per the latest release. So there's still a way to go before we get to a point where private sector lending can come back up. I'm going to ask my colleague Wesley to take us through the trade for the week.
Thanks, Melody. For the trade of the week, we hold a buy on EABL based on the back of a significant potential on the counter. We project a healthy top-line growth on the back of broad-based growth across all markets. That's Kenya, Uganda, and Tanzania. Also, on trades are projected to register strong performance given the easing in the containment measures, and spirits are expected to sustain a healthy growth in net sales, majorly from a likely double-digit growth in mainstream spirits, which is a key performer in the recent past, and it's expected to grow based on some factors. We will issue a company updates giving a new target price on the counter early this week. That's by Wednesday there, and more shall be shared as it evolves. Thank you.
Thank you, team. That was short and sweet, and we've taken note of your trading recommendations. So I'd like to swiftly go to our Q&A tab and see what questions we have for Melody and Wesley. We have one from Kamal. Kamal wants to know which counters are likely to gain or suffer from the recently released National Economic Survey. And his second question is, there seems to be a light bulb moment, I like the pun, there seems to be a light bulb moment for Kenya Power. How far can the price rise? So those are the two questions from Kamal.
I can give it a shot. So for the counters, I think because the National Economic Survey, the information has already been priced in by the clients in the price, because the information has already come to the public arena. So I'd say maybe it's just to look at which sectors outperformed last year. So we saw that mainly the construction sector, due to the high cement consumption for the government projects, of which that is the development expenditure we saw going up. Also, real estate, however, they've been affected by high steel prices. So they went up by almost about 50% last year. Agriculture, also, it did well comparatively last year. So those are some of the counters that you can say more or less would gain from the economic survey. So service industry we saw last year didn't do well. Now that's like the counters like TPS, Serena and such because of the lockdowns as well as the being listed on the red list. But as we've heard recently that UK has now scrapped Kenya from the red list. So that should boost tourism numbers coming the year going forward. So I would say that the information doesn't necessarily affect the counters per se, because now the information now is priced into the stock prices at the moment. But for me, in my opinion, those are the sectors that I see would gain from this information being released. For Kenya Power, we'd have to analyze the stock itself to see how far it will go. But we've seen that they're making moves. We've seen that they want to review the purchasing power agreements that have been termed as being quite expensive. And also we've seen that as part of the loan requirements by the World Bank, that are supposed to be some reforms at KPLC. So this is being seen as positive indicators of things to come in the future. Also, they had announced that they are going to return back to profitability. So it's just to wait and see how they're going to manage themselves, their company strategy. Yes, I hope I've answered it sufficiently.
Yes, you have. So Kenya Power has a potential for growth due to the steps that the organization is currently taking, but ultimately it'll depend on the company's strategy, right? All right. We have our final question from Titus. Titus is like, good morning. My question is, what is the resistance level for stocks like Equity, KCB, and Safaricom? Will Equity and KCB surpass the 60 bob mark and Safaricom reach 50 shillings? And also, will the election season next year affect these stocks? I know there's been a lot of growing concern about elections as it draws closer. So, Melody or Wesley?
I can try and give it a shot. Unfortunately, for resistance levels, I can't give a definitive answer because that one would need to look at the charts and figure out now technical analysis. But basically, from what we had valued before, both KCB and Equity were about around 52 to 53 shillings target price. So for hitting the highs of 60 shillings, I can't really comment on that because our target is more or less on the lower side. And for Safaricom as well, we're still reviewing our target price for Safaricom. So we'll just have to wait and see as the year progresses, the returns that they're going to earn. For KCB, we've seen that now the transaction for acquiring the Atlas Mara transaction for Rwanda is complete, and now it's just remaining for Tanzania. So it's going to give Equity a run for their money in terms of subsidiaries. Also, KCB has an eye of going into Congo as well, where Equity already is. So we might see some competition there. Safaricom, we've seen they have gone into Ethiopia now. And also there's been that removal of like in 2020, there was that waiver that was put forward by the government. Now that's removed. So you might see some improvement in the earnings as well. So with the election period next year, usually more or less it affects all aspects of the economy. So it's just to wait and see, because now this is going to be a complete regime change. So we're just going to see how the market responds to that.
Okay. Thanks, Melody. We have a question from our YouTube stream. It's Ken Mogane. Ken is asking, What is Scan Group's outlook in the next year? And could you speak to Corp Bank's outlook over the next year as well? So Scan Group and Corp Bank.
So I can touch on Corp Bank, and then Wesley can touch on Scan Group.
Sounds good.
So for Corp Bank, for them, they are not keen on, as we've seen the way KCB and Equity have been keen on expanding their geographical footprint. Corp Bank has said that they are taking a slow move on that one. We saw that they acquired Jamii Bora Bank last year, so that they can increase their market share, or let's say the presence in asset finance. We've seen also there's a project Kilele that is going to look at how they're going to manage their credit policy as well as just credit management. They also want to work more on their technological and digitization efforts. They're also banking on their M-Corp cash, which is, we can say, is more or less, let's say that their credit risk is low because the loans that they're giving out are tied to the check-off. So that has a relatively low credit risk, and the yield is rather good, about 8%. So we might see them pushing growth in their mobile lending arena as well. And so I think those are the main things that they're looking at, just their credit management as well as their mobile lending. Maybe Wesley can take us through Scan Group.
Yeah, thank you. For Scan Group, I think COVID has impacted the market it operates in such a significant way, and looking at how it will handle some of the costs, because in my opinion, one of the key drivers to sustain profitability or recovery will be how they handle costs. And we saw there was some exits they had in the previous year. As we wait for the results that were announced to have a delay, we'll have some more picture to project the company's growth trajectory in the near future. But as it is, we presume that the company will rise to its 2Q21 levels on the back, because what really drove the price to the levels they are right now or to their lows were the issues with the senior management that led to suspension of the CEO and the senior management. But since they were exonerated, we've seen that the investor confidence has been backed up in such a beautiful way, and the price has been rallying on the back of that specific news. So based on that, we see the counter might go back to its 2Q21 levels. But till we have the coming results, we can't really give a projection as to what's the point they can rise to. Thank you.
Okay, thanks, guys. We have one final question from Paul Mutengi. He's asking us to explain why we think the IFB1 2021-21 bond is attractive. And I saw Ian from our bonds desk joining us. So Ian, if you're on the call, could you please respond to the question by Paul? We'll give him 30 seconds. Oh, here he goes. Hi, Ian. I see you unmuted yourself.
Hi, Damaris.
Hey, how are you today?
Thank you so much. I have been following.
Okay.
With my laptop, I can't do a video.
You know, you can always print over to Melody and answer from her computer. I happen to both know you're in the office.
Yes. Anyway, about the IFB 21 or IFB 1 2021-21, the reason as to why we are thinking of attractive is because of the coupon. We realize we have not had a bond with a coupon of 12.737 in a while. So for this particular one, we are expecting, even for because today there are very many bonds issued coupon. and others we have partial redemption, and also there will be redemption as well. We're expecting that some of this money investors will be keen on reinvesting them in the market, and that is why we are thinking that the IFB21 will be very attractive for them, bearing in mind it has a very good coupon. So yeah, that's it.
Okay, I was going to say your connection was very spotty, but I think I got the main gist. Thank you so much, Ian. We got the main gist. Melody, could you paraphrase, because Ian was breaking off a little bit.
What I heard from Ian was that mainly it's attractive due to the fact that there's some maturities coming up for various bonds, as well as partial redemption. Now, this liquidity will make it more, or rather, how do I put it? Also, the liquidity as well as the attractive coupon rate will cause, or rather, will entice investors to go for this bond in secondary trading.
All right. Ian, I hope Melody has done justice to what you're saying. And actually, we're looking forward to having you as part of our weekly briefings. You see, they're very brief. And yeah, maybe we can touch base next week and share with you better equipment so that you can engage with us better.
Okay, that's okay, Damari.
All right. Thank you so much, Ian. That is the final question that was in our Q&A segment. So before we wrap up the session, I just wanted to let guys know that in the next 9 days, we're going to be launching something that has been named the Genghis Investor Starter Pack. It's a mouthful, I know, but it's a series of webinars that are intended to walk an investor just basically through all the different products of the capital markets. The format, thanks to the marketing team led by Dora and Daniel, is slightly different. It's not where we sit and we talk, but it's one that is based on Q&A. So we are very excited. I know as participants of the Genghis Weekly Investor Briefing, we already have your email addresses. So once we are ready to start registrations, we will reach out to you. We look forward to seeing you, all of you there. And if you are, of course, seasoned investors, because you've been with us for over a year, please pass it on to someone else who you think might be interested in learning. We hope to also have Melody and Wesley join us somehow in that webinar, because we're used to seeing them every week. So team, Melody, Wesley, you did a really great job. Thank you so much. We are excited to see you next Monday. And any final words before we finish, Melody?
None from me, just thank you. It's been an interesting and engaging session. And also thank you, Ian, for giving us a helping hand.
Perfect. You, Wesley. Wesley always has something very philosophical to add.
Well, it's always engaging. It makes the Mondays interesting. Thank you for joining us, setting aside 40 minutes of your life. It's not something that we take for granted. Thank you for joining us and being part of our larger family. And for Melody, thank you for your wise leadership. She's always out there with some good articulated thoughts, high-level thinking. For Damaris, Daniel and Dora, always being there, enabling all this, and Ian, always on the watch out. Thank you guys, and have a lovely investing week ahead.
Hey, Wesley, thank you. I don't even want to add anything else. Everyone else, have an awesome week. Bye.
Bye.